So here we are at the trial account, PowerOptions trial account. For those of you just getting started, I will encourage you to follow the 4 steps that are listed below here. But all right, let's go ahead and get to the first question from Eli. Eli wants to know, I want to understand Gamma better. Can you explain to me the basics of Gamma? Okay, well let's just go to a basic call chain, and I'll use a small stock. Let's just go to Texas Instruments for right now. Pretty big stock actually, but I just want to go to a standard expiration, and we're just going to look at calls only. And well, they did start offering 50-cent increments. So let me take another stock. I just want a simple chain here, so we'll just use GT for now. It's a position that I'm in. Oh, really? Let's see. Anyway, doesn't matter. We can use this one, but let's go ahead and customize our columns. Okay, so I'm going to keep this very simple right now, related to the 3 questions that have already come in. When you're on the search at any time, of course, or the option chain, you can click on Choose Columns. This will allow you to pick and choose which data columns you see. For a conversation related to the Gamma and the Vega here, I'm going to have the option bid price and the option ask price. I'm not going to worry about the high and the low, volume and open interest. I'm going to keep implied volatility there, percent implied volatility range. Okay, and we'll have delta, gamma, theta, vega, and rho. All right, and let me just get rid of all this other information here for the time value. I'll keep time value actually, and I don't want to worry about that or worry about that. Okay, so let's just customize our chain a little bit here. So here's our call chain now for Texas, or for Goodyear Tire. Okay, now over on the far left-hand side, that's where we have the gamma and are the Greeks theta, vega, and rho, of course. Delta is over here. I didn't order them, so delta is over there. We're going to have to reorder them to make this easier. Give me one more second. I'm going to go back to choose columns. Let's move everything up. All right, so I want my gamma next to the delta. So I'm going to want theta there, vega, and rho. Oop, okay, there we go. Perfect. Okay, so now let's clear this up. And as everyone can see, hopefully, there we go. Our Greek section is right here, the delta, the gamma, theta, vega, and rho. All right, so let's just take a look. With the stock at 30.32, a nice pullback today, which works out well for me because I'm in a ratio call spread against my Mary put where I've bought a 29 call and sold 2 30 calls. The stock went as high as 31.50, but now it's down to 30.32. I'm going to be able to roll one of those short 30 calls pretty easily and still take advantage of the dollar strike difference. But let's get to the point here. For 7 days remaining, the just in the money 30 strike call has a bid of $1 and an ask of $1.15. Now the delta right now is at 0.97. It's kind of high because there's only 7 days left to expiration. We'd expect this to be a little bit lower, of course, as well. All right. Let's see, just going through. Okay. Now, the gamma. What gamma relates to, as we know, the delta, of course, is what we would expect the option price to change if the stock gained $1. All right, so puts have a negative delta, obviously, but our call has a positive delta. So if on Monday Goodyear Tire opens at 31.32, it moves up 1 point, we're going to expect the bid price here of the option at $1 to go up to $1.97 roughly. Okay, we're going to expect to see an increase to maybe $1.95 or $1.97. We're going to expect it to gain 0.97 at that time. Now, gamma is effectively the measure of the change in delta. Okay, so this might not be the best example. We'll go to Apple in a second as well. Gamma is reflecting what I'd expect the change in the delta to be if the stock moved up 1 point. Now, of course, it's done in kind of a little different structure here, I believe. See, right here, my delta is at 0.97. It's pretty close to 1 for 7 days out. And the gamma is showing us at 0.402. And what that really means, it's not 40 cents. It's going to be about 4 cents, close. So if the stock moves up a point, we're going to expect this to go up to about 101, a delta of 101. It can never reach that high, so it would go to about 1 there. So the gamma is measuring what change in delta you'd expect for a 1 point movement in the stock. It's the change of delta, the rate of change of your delta on your option. So how do investors typically use this? Let's go to Apple. And I'm actually going to go to a further out chain for Apple instead of being something close in. Let's go really far out. I'm going to go to January 20. Okay, so we just have a few options here. Now see, here's a little bit better view. Right now, the 100 strike, Apple's at 103. So let's use the 105. Slightly out of the money, 105 strike, priced at around $5. And we have a delta of 0.47. By the way, that's what you'd expect to see any delta for an at-the-money option. Whether your stock has a high volatility or low volatility, the at-the-money option is going to be around 0.5 delta. All right, it's supposed to gain 50 cents if the stock moves up 1 point. So if on Monday we see Apple open at 104.37, up 1 point, our expectation would be right now that our option would go from $5 to $5.50. But we're seeing a gamma now of 0.026. So we'd expect the delta, if the stock moved up 1 point, was trading at 104.37, we'd expect the new delta to move from 0.47 to about 0.496, or probably rounded to 0.5, because it's just at the money, isn't it? It's pretty close. That's what we'd expect to see. Now, of course, as that moves up 1 point, we're probably going to see the delta change as well to another range of maybe 0.027 or 0.028. So if we gain another dollar and Apple goes up to 105.37, well, now that the delta was at 0.50, we'd expect the call to go up to 6. Okay, with a stock at 105.37, expect the call to go up to $6. Remember, this is a January option. It's far out in time. And then, of course, the new delta would change now from 0.50 probably up to 0.53 or 0.54, depending on what the gamma was. All right, so that's a better view of the change in gamma there as well. Okay, now, anytime you're on Power Options and you have a question about this type of criteria, remember you can always simply hover over the description there or the link on the option chain or on a search, and you'll get a definition. Okay, Vega. Well, first let me go back to gamma. How is gamma used? Okay, it's the change in delta. What some investors will choose to do is, instead of just having a portfolio or a spread position that's delta neutral, they'll look for a position that's gamma neutral. So they'll be short an option that has maybe a gamma of 0.5, or in that case negative 0.5, and they might buy two other options on the chain that have a gamma of 0.25. Or we could call it 0.05 or 0.25, okay? So in that situation, what we're going to look at as well is that I might buy two of the 0.025 gammas and sell one of the 0.05. So as the market moves up, I should be gaining gamma equal to what I'm losing. That's gamma neutral. Some investors try to do that. Most investors try to focus on being delta neutral, of course, where they might do different combinations and ratio spreads. So if I bought, let's say, this option at 0.60, I might try to sell two options here at the 110 with a delta of 0.34. So if the stock moves up, I gain 60 cents, but then I'd lose this 68 cents here, or vice versa, in theory, okay, based on that. So that's how gamma is used. Vega is similar, but it's what we would expect the change in the option premium to be for a 1 point change in implied volatility, or 0.10, okay? So we look at the implied volatility here for our 105 strike call for January. We have a delta of 0.2429, or some of you might call that 24.29% implied volatility for this option. If the implied volatility goes up to 0.2529, or let's say 29%, if you look at it that way, then what that's telling us is that the Vega, we'd expect an increase in our call option of 25 cents. So if we look at Monday and this goes up to 0.2529, I'd expect to see a premium of 5.25 on the option. Okay, well, is that how it's going to work? Let's take a look. I'm going to go to the custom spread tool on Power Options real quick. and we're going to put in Apple, and we're going to look at that out of the money 105 call for January. Okay, we're just going to call it a price of $5. So we just bought one contract for $5, Eli, okay? Now, based on the Black-Scholes theoretical pricing model, let's say that volatility stays the same, and on Monday, our stock goes up to 104.37. Okay, remember we're at $5 right now, and the expected value of the option would be 542, okay, based on the Black-Scholes pricing model. So it's close to 0.5 there is what we saw, okay? Now, it won't be a gain of 42 cents. But let's take a look here. Let's keep the stock at the same price in the custom spread tool at 103.37, and if my volatility goes up to 0.2529, okay, let me erase the drawings there. Yeah, it's close. It would go up to about 518. Okay, so the Vega showed us that it should move up to 25. The Black-Scholes pricing model says it's going to move up to about 18. Okay, so there's a little bit difference there as well. Okay, all right. So that's kind of what you're expecting. Now, again, as I mentioned, if the stock did move up 1 point, we had the current gamma, remember from the chain, of around what was it, 0.0246. Okay. So again, if the stock moves up 1 point on Monday, this is the gamma. The stock moves up 1 point on Monday, well, then we'd expect the delta to change from 0.47 to 0.49. All right, so that's plus $1, and then the gamma itself would change to maybe 0.28 or 0.27, something along those lines. They're ever moving with each other. Okay, so that's how gamma works. Gamma is a reflection of what you'd expect the delta to move for a 1 point movement of the stock, and your Vega here is what expected change you'd see in the option price based on a 1 point movement in the volatility or the implied volatility as well. Now, Eli had a follow-up question before we get to Mike's question, and Eli asks, how do you detect high IV? Okay, well, first, I want to show everyone something that you may not know is on the site. It's kind of hidden, but it's something that I use in general when I'm talking to customers. So I get a lot of calls. I'll review this call. I had a call earlier this week where a customer asked, I want to find the highest priced options. Show me how to use your search to find the highest priced options. Well, I had to tell the customer that he's not asking the right question. Okay? If you want to find the highest priced options, naturally you're going to be looking at stocks that have the highest price, and you're going to look for the deepest in the money option, right? If I looked at Priceline trading at around 1,600 or 1,700, wherever it is, the option with the highest premium is going to be the one that's the deepest in the money on the highest price stock on Priceline. If I found a $100 strike available for Priceline, it'd be worth about $1,500. So that's the highest one. But that's not what you're asking. What you're asking is what options are the most inflated and have the highest time value, okay? Which also may dictate that they have the highest implied volatility. But first, before we go into the search and see how to do that, what is high IV? Okay, well, on PowerOptions, underneath the Home tab, if you go to the Learning Center, you have a listing of various things here as well. And there's different tabs here for market activity, ex-dividends this week and earnings announced this week. But if I go to market activity, this menu here, we have market statistics, so get a quick view of today's stock and option market activity. You can see which options have the highest volume and which stocks were the highest traded and so forth. But we want to look at optionable stock statistics. What the optionable stock statistics are is an average where we can see the mean, minimum, and maximum of various securities. So stock last price, option bid price. The mean is about 1056. Okay, option last, option ask, and so forth. All right, now why I wanted to come to this page is that down here, what you can see, of course, is the implied volatility, the 20-day, the 50-day, 100-day, and 250-day for the stocks, as well as what's called the SIV. That's the Stocks Implied Volatility Index. So the mean implied volatility on all options right now is 0.90. Probably would have been lower yesterday before the little pullback we had today and the increase in the VIX. But right now, the average implied volatility of all options across the market is 0.90, which is interesting, isn't it? Because the average volatility of the 20-day, 50-day, and 100-day for all stocks is around 0.27, 0.33, probably an average of about 0.33, 0.34, okay? So that's telling us that right now, as much as you think that options are priced cheaply, or that you're not finding the premium you want on the stocks that you're tracking, the average is showing us a high implied volatility to historical volatility across the market right now, okay? So why did I want to show an average implied volatility of 0.9? Okay. Eli, I'll be right with you in that in a second too. It's different. Eli said, does this relate somehow to IV rank or IV percentile, or is that different? That's different. Okay, and I'm going to show that in just a moment. Okay, please tell me I didn't just do what I think I just did. I did, but it's okay. I can get back to that in a moment. All right. So now that we have the average there, and there's other things. If you wanted to know what the average delta, shouldn't be a surprise, is 0.5. You average out all the in-the-money and out-of-the-money options, the average delta is always going to be around 0.50, okay? But other things, you know, for this average market cap, average earnings per share growth is 3%, so forth. Okay, so you can check that out at any time. Remember, it's under the Learning Center, and then you click on market statistics there, market activity, excuse me, and then you click optionable stock statistics. Okay, so why is that important? Well, let's just go to a naked put search, okay? Selling a cash secured naked put, we'd want to be out of the money. But what we want to know is, let's say that I want to trade naked puts. I want to do cash secured naked puts, and I want to look for overvalued options that have a high implied volatility. What does that mean? Well, let's just go out to standard October expiration. I'd want to be maybe, let's just say 3% out of the money or more. I want to look for out of the money naked puts. Now, I'm not going to worry about price. I'm not going to worry about stock fundamentals or technicals. All we're going to show you is that, well, I wanted to look for options that had a high premium and a high implied volatility. How do you detect high IV was the question, okay? So on average, we know that the implied volatility is 0.90. So I'm just going to look for an implied volatility of greater than 1 or 100%. I could look for options that are overvalued with the IV over HV. The implied volatility of the option compared to the historical volatility, which indicates an overvalued option. So ratio of 1 means that the implied volatility is equal to the historical volatility. A ratio of, let's say, 1.2 would mean that the implied volatility is 20% higher than the historical volatility of the underlying security. All right. Now, your other question, Eli, is about the percentile rank and everything. This is what we call the percent implied volatility range. I know there are some services out there that do a volatility percentile, and they do it to me in a strange way. Okay, what some investors, some services do is they show this IV rank or IV percentile rank over a 1-year period. That is something that doesn't make sense to me too much, and I'll explain why. Let's say we're looking at a stock trading at $40, okay, right now, and we're looking at the October naked put, naked call, covered call, whatever we're looking at. We're looking at an October series, which we saw is about 42 days away. Now, over the last year, this stock, let's say, has moved from $12 per share up to $47 per share. You can't see that. $47 per share, and has now come back down a little bit to 40. All right, so the IV rank or IV percentile, which some services use, what they're looking at is that, let's say, well, the stock's at 40, and let's say I'm looking at selling at 37.5 October put. Well, this rank, what they did is they look at the IV for the 37.5 strike option over the last 12-month period. And they say, oh, where is your IV of this option now compared to where it has been? Here's a problem. Number one, when the option was at $12 or $14 or $15, this 37.5 strike didn't even exist. Number two, since this is just a regular October series, it likely has only been available for 4 months, not 12. So you're comparing it to unrelated market conditions for the implied volatility of the option. What our percent implied volatility range shows is where is the option's implied volatility right now compared to where it has been over the life of the option. So whenever this option, this October option was released, let's say it was released in July. So we're tracking the entire implied volatility values from July until now. And the percent implied volatility range is showing you where is the option's IV now compared to where it has been over the life of the option. And let me show you an example of that. So here, I just wanted to explain that first. That's the percent implied volatility range value and how we use it. But we're looking for what we consider high implied volatility and high IV over HV for October. Okay, I didn't put anything for return, anything for stock criteria, anything of that nature. And we have tons of results. Okay, a lot of therapeutics, 2 times, 3 times ETFs and things of that nature. Okay, so first, let's narrow this down. Let's say I didn't want to see any 2 or 3 times ETFs, any bullish or bearish multiple ETFs. So I'll go to the lists field, and in the stock list section, I'm going to exclude indexes and ETFs. I'm just going to remove all evidence of indexes and ETFs from my search. So now we'll just look at the standard stocks. Okay, now, very good. So now we have our fields. We expect what we see. Sarepta Therapeutics has been up there all along. Area Pharmaceuticals, Noravax, I don't know that company. But these are all the positions with the higher implied volatility, maybe a higher implied volatility range. But let's look. We don't have that selected. So we're going to go back in and choose columns. I'm going to take out some of the material we don't need, such as delta. No, we'll leave Black-Scholes ratio in range and around of the money. IV over HV we want. We want the percent implied volatility range. I want the time value and the percentage time value as well. And of course, I want the standard implied volatility. All right, so let's change the column order now that we've done that. So let's see here, option bid price. Let me put implied volatility next to the option bid price. Then I want the IV over HV ratio next. The percent implied volatility range, time value, and percent time value. And next to that, I'll put the Black-Scholes ratio. Actually, I'll put that under IV over HV. Okay, let's move naked yield down. Okay, good. Let's go ahead and change that. All right, so look at these implied volatilities for these stocks we just found. All right, everything's almost at the 200% range. Remember, we saw Apple, it was at 0.2429. This is at 2.016, 1.9. So these are the options with the highest implied volatility. I can choose to limit this now. We could do further restrictions for stock criteria and so forth. We could choose to sort it by the highest implied volatility. By the way, what's interesting, you'd expect that something with a implied volatility right now, if let's say for this Novavax, I keep wanting to say Noravax, but Novavax is at 211%. And it's at 98% of its percent implied volatility range. Whereas Sarepta, we see here at 2.0, or about 200%, and those options are only in the 40, 50, or 35 percentile since the option was released on the market. It's actually been up to about 2.5, 2.6, I believe, for the implied volatility on some of these options. Okay, well, how can you check that? Anytime you're analyzing an option, whether you're on the search, you're on the chain, for example, I'll take the Sarepta one. We can go to the research tool here, and I can go to the option research menu. This gives me a breakdown of all of the data that we have for that particular option with a chain, or a historical chart, I should say, down below. And right now, this is just comparing the implied volatility of the option versus the option bid, but you can customize it if you want to look at delta versus implied volatility, time value versus open interest, what have you. But notice that the data only goes back to 8/22. Why? Because the October series for Sarepta was not released on the market until after August expiration on the 19th. So Monday, August 22nd, is when the October series for Sarepta was released on the market, and we see that the actual implied volatility range was 1.82 to 2.27. So right now it's about 1.98. It's actually in the lower range of its implied volatility value for this particular option since it's been released. Let's look at a stock chart very quickly. And remember, we're looking at the October 26 put for Sarepta. Now see, the stock was up at 40 before. Okay, in the last 12 months, the stock's been up to 40. That's about the high. It's been as low as, let's say, 10. So we're looking at a 26 strike put. Now, as I mentioned, this is why I don't know. If someone wants to explain it to me and you think it's better, by all means tell me. And what I mean by that is that I mentioned that the percent IV range, or the IV percentile that some services use, they look at the IV for the 26 strike option over the entire 12-month period. Okay? So what I'm concerned with is that at this point, the 26 put would have been so deep in the money, it probably just had a delta of one was trading right at parity and probably had a lower implied volatility, even though this was a volatile stock. And at this point, when it's at 10, it was over 50% out of the money. So of course, the 26 put would have existed because these series out here to April, to May, and to June, and so forth, if there were series available on or around January 15th or 16th for Sarepta, they have to keep trading, of course, right? But options that weren't released here, when the stock was trading at 10s, there wasn't an October 26. There might not have been 26 strikes for the August series yet with the stock at 10. They would have come out as the stock continued to move back up to this price range. And by the way, I'm not saying that Sarepta is a great stock. I'm not saying that Sarepta is a buy or this is a good naked put candidate. I don't think it is right now because of the volatility. However, that's why I prefer to, whoops, sorry, so I think something weird just happened. Nope, you're still good. That's why I think it's better to just look at the IV range since the option was released, so you're actually looking at the changes of this actual option and all its changes in volume and open interest since it was released on the market, okay? All right, well, Eli's follow-up question, then we got to get to Mike's because he's been patient. He says, yeah, the IVR and percentile is for the stock, not a specific option, okay? Now, I understand that, but some people do use an IV rank for a single option, and it kind of drives me nuts, as you can tell. Yes, but the volatility rank, well, you could say that if you know, remember when we looked at that series, the 50-day volatility average on the market was 0.33. So you'd think any stock that's above 0.33 would be considered to have an above average historical volatility or stock volatility. Anything below 0.33 is below the average. It's lower. And in general, things like, you know, Johnson & Johnson and Kraft, you expect them to be around 0.12, 0.15, or 15% volatility, whereas things like Sarepta is probably much higher. Okay? And again, just as you saw, Eli, in the search here, we showed you how to use the implied volatility, how to use the IV over HV to look for overvalued options. I could put specifically to just look for stocks when I'm selling that are above 90% of their implied volatility range, so I'm hoping it's going to revert back to the norm. And if I'm buying, I might look for ones that are less than 30. But for your question, if I go into the technicals, you can screen for historical volatility as well on the stock. So you can limit it down to look for stocks that have a relatively high historic volatility. And what did we know? We looked at the average just a moment ago, Eli. We saw the average across the market for the 50-day volatility was around 0.33, 0.34. So let's double it. I only want to see stocks that have a historical volatility greater than 0.68. And we might not see Sarepta. We should see Sarepta in here, but we might not see one of the other ones because you can have stocks where the stock has been stagnant or it's only moved up 3 or 4 points or so in the last couple of months. But the implied volatility for some pending event coming forward, which, by the way, notice what's gone. Sarepta is gone out of the trading results. Why? Because even though we took a look at that chart a moment ago on Sarepta, let's go to the chart here again for Sarepta real quick on big charts. Even though it's been all over the place from 40 down to 10 to 0.26, the average implied or the average historical volatility for the stock is fairly low. It's lower than 0.68, even though the options are double that. Why? Because there's an event coming up that could cause Sarepta to swing wildly up 20%, up 40%, or down 60%, or down 80% based on the outcome of the, I don't know, I think it's FDA approval of phase 3 trial or a pending lawsuit coming out for Sarepta. So that could change the stock drastically. But in reality, the 50-day volatility, it's not that much, is it? Stock's not moving that much. But the options are overinflated because it's all based on the event coming forward in the next month or so. what is the volatility? Let's take a look here. Let me just go back here, and let's go to the stock research tool. All right. So the 50-day volatility is at 0.50 for Sarepta, even though the near-term October options are at 200%, 205%, and so forth. The volatility of the stock is only 0.5. But you go back 100 days to where we saw that dip down to 10 and coming back up, it almost doubles, triples, really. It goes up to 1.55. But the near-term volatility is very low because the stock really hasn't moved that much. We saw that from the chart. But these other ones, okay, these other ones that we see, I'm sorry, in this search here, in the last 20 to 50 days, you know, it's had a little bit more jump. It's because of lower price stock. It's gone up to almost 12 and it's come down. So it's had about a 20 to 30% move in the last 60 days. You know, from let's say 14 here down to 9, you know. So that's something to look at. It was a good price stock. Not, you know, we should expect this. Let's look at Clovis, which is at least a $27 stock. All these are in the $3 or $4 range. Okay, so we big gap down there, and it's doubled. You know, it's gone from 15 to almost 30. It's at 27.65 in about the last 50 to 60 days. Looks like there's an event a month ago. There we go, where we jumped up from about $17 to share to 24. Must have been earnings. So that's why this one has an extremely high historical volatility on the stock. That's what stock volatility is called, historical volatility. Whereas we lost Sarepta, although the options are highly priced and have a high implied volatility, the stock has not moved that much. Okay, so now we're going to take a look at Mike's question. Mike is looking at what we call the radioactive trading positions, married put positions, and he wants to know, is that initiating married puts during a rising volatility, does it matter? I had a discussion about this a little while ago. Notice on my search, Mike, that I just pulled up for my married puts, I have the standard things that you would have in your search. I've got the stock, I've got the put, the ask price, the calculated percent max risk, earnings per share growth on the stock, so on and so forth. But I've also added not only the implied volatility, but the percent implied volatility range. The reason why I did this is, let's take a look at Alibaba holding here. It's currently at 99.69. We're shown we could buy the April 100 put for 960. This would give us a risk of 929 or 8.5%. Now, the implied volatility is 0.304, but it's at the 86th percentile of its percent implied volatility range. I might be very hesitant to enter this particular position. Okay? Why? Because if the implied volatility reverts back to its norm and goes back to let's say 0.20, even if the stock doesn't move, I would lose value on the put without the stock moving if there's an implied volatility movement. Okay? That can be troublesome to further get value out of doing income method number 4, income method number 3, or income method number 9 if your option just dissipates in implied volatility. Now, all that being said, I want to take a look at this. And I know this isn't your actual question, but I want to take a look at this first. All of this talk that we've had about why I like to use the percent implied volatility range I do and everything of that, I'll admit freely that I still have to take this with a grain of salt. What do I mean by that? Well, I'm showing Alibaba this April put with an implied volatility of 0.3040 and a percent implied volatility range of 86. However, if the total range, the actual true range of the implied volatility of this April option since it was released on the market is only 0.28 to 0.31, and right now it's at 0.30, which is at the 86th percentile, that's a nothing movement. And 0.28 to 0.30 is not a wide shift at all for implied volatility. So that wouldn't cause me concern. Let's take a look. What is the actual implied volatility range? And I was close. I was dead on. And no, I didn't look at that before, but that was the theory that we had. The implied volatility range, since this option has been released on the market, is 0.27 to 0.31. And right now it's at 0.304. So even though when buying an option, this has a percent implied volatility range of 86, I'm okay buying into it because even if it goes back to 0.27, I'm not going to lose too much on the position. Okay, I'm not going to lose a lot to volatility decay or volatility crush as we call it. However, if the actual true implied volatility range was 0.10 to 0.38, and right now it's at 0.30, and that was my 86%, I would not enter this position because if the implied volatility goes back to 10, I'd lose 80 to 90% of the time value that I just paid into this put. Now, it's a deep in the money put, but it does have a time value. Okay, the time value of the ask price was $9.29. So if this reverted back to an implied volatility of 10, this would probably only go down to $1. And that's just, I lost $8 off the put right away. Now, that doesn't change the fact. Even with an implied volatility crush, that doesn't change the fact that my maximum risk, the most I can lose is I'm sorry, it's not on Alibaba anymore. There we go. 8.5%. That doesn't change. You know, I'm paying $9.60 for this put that's really just at the money. Okay, so it's close to at the money, but my time value is $9.29, which is my true risk. Even if the implied volatility dropped to 0.05 or 5% from where it is right now at about 30%, and this went to $1, I still can't lose more than 8.5%. Okay, that would make it more difficult for me to do an income method number 4 to put myself in a better position, or 3 or a 9, for example, manipulation of the put option. But even in a volatility crush, I cannot lose more than that 8.5% because it's based on the math, the total cost you put in, and what you're guaranteed to get back, $100 if you exercise the put. So even if this put drops to $1 and the stock doesn't move because there's a volatility crush, which would never happen that way, but even if it did, you still can't lose more than 8.5%. But it's going to be harder to manipulate the position. Now, what you're really asking, I know, I just wanted to bring that up as a helpful hint. I do encourage investors to use the percent implied volatility range for the married put screen to maybe keep that percent implied volatility range less than maybe 70% or so when looking at new married put positions, so you don't suffer a volatility crush if there was a wide range of implied volatility for your option. What you're really asking me is the market fell today. The VIX, the VXX, the volatility's increased drastically. Let's go back. Okay, so the volatility, the VXX, you know, is up 34% today. The VIX, I'm sorry, is up 34%. VXX I usually have added here. That's probably up, wow, 5 points. Okay, so almost about the same amount. Well, now it's probably closer to 20% movement on the VXX. The volatility jumped up today, 2% decrease across the markets. Okay, so what you're asking is, hey, the market's falling today, implied volatility spiked, is now a good time to enter a married put, or would I be overpaying for the put option in that situation? Okay, well, once again, we saw several examples here that match the radioactive trading criteria, where even with today's movement, I still have tons of options where they're only in the 26th percentile, 43, okay, this one's at 73, this one might be too high at 63, 22 and 29, we already talked about the 86, but that would still be worthwhile. There's one at 19, 38, all right. So what I'm showing you is that these are relatively low percent implied volatility ranges. Volatility didn't increase that much, it did move up. The reason why you're not seeing that much of a change, Mike, is because of the way we structure it. Because we're going at least 150 days, 160 days out in time, those farther out options are not going to react as quickly or react at all to this type of subtle 2% market movement during the day. You know, they're not going to be as effective. They probably moved up. The implied volatilities of these options probably did increase. Let's take a look at Newfield, NFX. It's about a $45 stock. The March 46 put right now has an implied volatility of 0.38. Okay, so let's do something neat here. Let's go to the well, maybe I won't do it here. Let's go to the option research tool anyway. Okay. Yeah, I was afraid of that. But that's okay. So what we can see here is that the implied volatility we know right now is at 0.3813. Newfield dropped about, was it $1.10 today, $1.20, $1.30. Okay, so it's down $1.30. It was probably trading at $46 per share at the open. So it dropped a decent percent. Now, the 46 put, again, has an implied volatility right now of 0.38. This is the March 46 put that's 189 days out. And based on our chart, we can see here that it's about 0.39 average today. It was at 0.38 at the close of yesterday, 0.4, so it's actually dropped. Now it's at 0.37 here. So what you're seeing is this option is not going to be as reactive. Now let's change this. Okay, as a example, let's go to the option chain again, and let's look at the 46 put for September, which today, I don't have it there, but let's look at the 46 put for September, 16 days away. The implied volatility is at 0.35, and you see here that it's had its movement. It's gone to 0.3, 0.33, 0.34, 0.33, and today it's at about 0.36. All right, so yesterday, I'm sorry, it's at 0.33, but today it's at 0.36. So this one's moving up. It's reacting faster to the change in the market as opposed to the March option, which is further out in time. Okay, so basic underlying question underneath of what Mike asked as well. Okay, so are you going to be affected too much by the puts? No. Look at the numbers here. The percent implied volatility range and the implied volatilities are all relatively low based on the search criteria that we're using. So I wouldn't be concerned with opening any of these positions right now. I wouldn't be concerned about a volatility crush. Now, what you're asking is the volatility fell today. The volatility is increasing. Sorry, not the volatility. The volatility is increasing today because the market fell. Is now a time to initiate a married put? Well, here's a rule of thumb I have. Okay, and this applies to a lot of strategies. I'm going to point you all to a webinar where I discuss this a little bit more. I know that Greg got into Paycom. It's one of the three portfolios that Fusion subscribers can follow at RadioActive Trading. You can see Ernie's married put trades, my RadioActive trades, and Greg's RadioActive trades. Well, Greg got into Paycom earlier today. It closed last night. I'm sorry. It was up at $51. I think he has the February 55 put actually. And his position had a risk of, I think, of about 6%, and he had a low liquidation value yesterday with the stock up to 51, where he could close it out for about a loss of 0.5 or 0.6%. Well, the stock reverted today and is trading at 49.64, but I could still open this married put with a risk of 5.4%. Would I do this? Well, if I like the stock, it has the risk that I'm looking for, and the strike price I'm selecting matches my target price for the stock over the next 30 to 60 days, 20 to 40 really for me, yes, I would. So this has been a good stock. There's been a hiccup today. Now, the question you're asking, and I don't have an answer for, but what you're asking me is, should I open a married put now because the market's been falling? Well, I don't know. What I'm looking at is what is my target 20 to 40 days out, not necessarily what happened today and what's going to happen tomorrow. When I open a married put position, it's because I have the expectation that the stock's going to move up maybe 4 to 8% in the next 20 to 40 days. Even with today's hiccup, if I had a strong confidence in Paycom that it was going to continue to move up in price, that this is just a hiccup, and then in the next 7 days or so I expect it to be back up to maybe 51, and by the end of the following week, around the 23rd, I expect it to be near 54, this is a good time. If you're concerned that this is just the start and that we're going to see maybe 4 or 5 more days of the market dropping 0.5% or 1% each day, so we might drop another 5 or 6% over the next week, then no. Why would you open any bullish strategy in that situation? If your outlook for the next 6 to 7 days is bearish, you want to be looking at a bearish strategy, don't you? You don't want to do a bullish strategy, you want to do a bearish strategy. If you're in a married put right now and you think this was the start and we might lose another 4 or 5% of the SPX and the overlying market prices over the next 14 days or so, you might want to consider one of the income methods in the blueprint, maybe income method number 12, to take advantage of the downside if you feel it's going to move against you. Or wait until it bottoms out, you feel you've hit the bottom, then use income method number 9 to adjust the put position at a lower strike so you have more advantage of the upside as well. So with volatility where it is and going up, it went up today because the market went down, that's just what happens. And you know, you could use, there are people that speculate that this type of 34% movement is an indicator of more to come, and they might expect the VIX to go up to 20 or 22 within the next 3 or 4 days. In order for that to happen, the market would continue to decline. So would I open a bullish strategy, a covered call, a naked put, a bull put credit spread, bear call credits, or I'm sorry, bull call debit spread, or calendar call spread? No. Not if my outlook for the next 10 days was bearish. I'd open a bearish strategy, a long put, a calendar put spread, a bear call credit, okay? That's what I would look for. If we're neutral at this time, we think this drop is over and the market's just going to hang where it is, then sure. I'd buy married put only on a stock that I feel has the potential to move up 4 to 8% in the next, let's say, 20 to 40 days, maybe 30 to 60 days or so. That's what I look for when I'm opening a position. But when I open a married put, make sure that the risk is where you want it. If you see, don't necessarily use this as your factor, the percent implied volatility range. Don't use that as a factor to determine which married put you should buy. Research it to make sure that the actual spread isn't too small. But if you're worried about a volatility crush, then naturally you'd focus on these here. But again, if you're bearish, don't open a married put. Okay, so let's say I really did like Paycom, I'm sorry, the Paycom position, Paycom software, but I do think that the market's going to continue to drop over the next 3 or 4 days. Well, then I might wait. If I like, I don't mean to sound like a gecko here, but if I liked it at 49.64, I'd love it at 47, right? If I liked it at 50, I'd love it at 45, okay? So if the market continues to go down, implied volatility would move up. So let's say 5 days from now, I look at this position, and the stock's trading at 45, and I'd be looking at a February 50 put, and I might have a risk of about 6%. Okay, well, if I think it's bottomed out, then I would do it then. As long as my target for the next 20 to 40 days was the stock would be trading at or near $50, where I'd look to do one of those income methods, potentially 1 or 4, maybe 6 or 5, something along those lines. Okay, so if you're still bullish on the stock and you think this is just a hiccup, then yeah, I'm not concerned with the fact that volatility increased, and I can tell that my put options are not overpriced. They're well within a reasonable implied volatility and implied volatility range on this search, and that's what I'm looking for. And if I'm bullish on any of these stocks, I think they're going to move up 5 to 6%, then that's what I'm going to look at as well. Okay? All right. Okay, so let's see here. Let's see, what did I do yesterday? Oh, I'm sorry, hold on a sec. Oh, yeah, Sam, yeah, Evan, Sam, I'm sorry, he's getting to his questions now, but he had a couple of questions. He was saying that TiVo is up about 100% from yesterday to today, and that's because they partnered up with that other company there. So TiVo's at 2180, and we look at the stock chart. You know, this was a huge move, stock. Oh yeah, so it's moved up from 11 here to 22 just within the last year, you know. So it's doubled in price over the last year. And we saw some hiccup movement yesterday when it was up here because of that merger they had with the other corporation. All right. Now, Sam's question, the main question Sam had is, how do you find good spread trades with the suite of tools? Well, not to be provincial, but it depends on what you consider to be a good spread. Now that I've got that out of the way, let's go back to our conversation we were just having. Let's say, Sam, that I was bearish on the market, that this drop today I felt was just something that was a starting point, and over the next 7, well, let's call it 5 to next week, or maybe 10 days to the middle of the following week to the 19th or 20th September, I think the market's going to continue down. All right? So what I'm going to do, even if it stagnates or moves down, okay? So what I'm going to do here is just go to, I'm going to take out whatever, Iron Condor, and I'm going to add in bear call credits, okay? And look for bear call credit, and let's go to search. All right, now, what is a good spread? Well, the reason why we've designed these tools is because everyone has their own definition of what a good spread is. Some of you will feel that the spread positions that are within 7 to 14 days out in time but have a probability above 90% and are still offering a 5% yield are the best positions. I'm not going to argue that with you because it's the best position for you. It makes sense based on your risk threshold that that's what you want to see. Other investors are going to tell me that the best spread is the one that's 5 to 7 days out, has a net return of at least 11%, and I'm not worried about the probability as long as it's above 50% and one strike out of the money. Well, that's your risk threshold, and that's great. That's fantastic. So however you consider the best spread, That's how you'd customize the tools. So you said, you know, I can't do the search. We can do the search historically, okay, Sam, and I can show that. That's easy enough to do with what you just said. But since the market's closed today, we can't look for 1 day out to expiration. We're going to have to go, and all the updates have been done for $0. I can't illustrate running a search today for a 2-day spread. So, but what I can do, when I go to any search, I'll clear the filters first. Let's say we want to look next week. So I'm going to set my days to expiration to between 1 and 7. I'll go 1 and 8 actually. And now I'll just set in the rest of my field. What is a good spread to you? You said that you found a 60-cent credit on a 5-point spread. All right, so that's going to be above about a 12% return. It's going to be higher than that, I know, but it's at least 11.1. So a net credit of 60, 12% return. I want to be at least maybe 3% out of the money with a 80, let's call it 80% probability. Okay, let's go ahead and see if anything exists for next week's expiration. No. Okay, so it's a little bit too restrictive. Let me make sure my time frame is right. Let's try that again. All right, so it's not there. I don't see anything that has at least a 60-cent net credit, 12% return, that's 3% out of the money. If you were dead set on this minimum net credit and return, the only way to open this up now is to lower the percent out of the money and lower the probability. You've admitted that you're not going to lower the premium or the return, so let's go 2% out of the money, probability is 70. All right, so I've got Tesla with 190. I mean, that's for a 7-day trade. It's at 194. And it's at 200. That's a little risky for me. Amazon, iShares, Cracker Barrel at 147. We have 23 total results. I don't think CMG is there for the 470, 475 for next week. Okay, so why not? Well, let's take a look. I'm going to leave this here. And let me refresh this page. I'm sorry. What I want to do is go back to the bear call credits. I'm going to go search by symbol. Let's go CMG for September expiration. Okay. And let's see. Minimum net credits. Look at those net credits on CMG. Here's one at 80. Okay. It's a 7.5-point spread, but the return was under 12%. Okay, so maybe we could lower that to 11%, and that CMG position would appear. Here's one at 105 with a return of 16.3%, but it's using the 435, 442. I'm sorry, that just looks like a weird little smiley face there, doesn't it? And with the stock at 427, we don't have the probability that we'd want. Okay, so it's probably not at a 70% probability with a drop of 8 points today, since the stock was already above 435 at the open today. Okay, so you're saying you got a credit of 470 to the 475 calls. They're not going to match our search right now. For the 2-day trade you did today, they're not going to match our search right now because this is the September series. We don't even go up to the 470 because the minute we do, look, we're already at 10-cent spread. Maximum 25, 20-cent spread between the 445 and the 450. So you wouldn't see the 60 spread today. Now, all that being said, let's go back to the search. And what did I say? If I'm going to lower my probability is about right. Oh, shoot. I'm sorry. It didn't. That's not where I want to be. I want to be here. My apologies. Let's lower this to 11.5. We opened it up to 27. I was expecting CMG to be in there, but maybe, oh yeah, that probability is probably not at 70 either. But in any case, let's do something quick here. Our bear call credit, let me go to backtest. And I'm going to pull up a search from Wednesday. Ignore this, I'm just going to pull up a basic spread first, Sam, and I'm going to go back. All right, so I just have to put in a minimum search first. There we go. All right, so these are just some of the spreads, but let's do exactly what we did before. I'm going to clear the filters, Sam. We're going to look 0 to 3 days out. So this would have been on Wednesday. I'm going to look for today, Friday, as of Wednesday. Net credit of 60. Return is irrelevant, but we'll put in at least 11. and a probability of greater than 70, and at least, let's say, you were way far out of the money, but I'm going to put at least 2% out of the money or more. Let's just see if we find anything. It's probably my fault there. Yeah, that was my fault. Okay, so that one didn't come up. Let me take a look here as to why. I have a suspicion why. Let me take a look, Sam. Let's go to, that's good enough. Let's go to the chain for CMG. All right. Calls only. All right. So on Wednesday, all right, got to open it up to medium chain. My apologies. Yeah, see, here was the problem. That would have been the problem with our search tool, I'll be honest with you. You wouldn't have found it using the search tool. The reason why is because the zero bid to the 310 ask for these deep out of the money options on Wednesday. The system in the builder right now is naturally looking at the natural bid for the sell option and the natural ask for the long option. And the trick here is that the system won't build a short option for part of the spread if it has a zero bid. Okay, I could have used the spread chain to identify the positions because it uses the midpoint. Eventually the builder will use the midpoint, but for right now, these options here, if it has a zero bid, it's probably not going to be building those for the 1 week out. Could have gone out here and it would have shown me this spread for the next week, the 470 by the 475. But yeah, based on, I guess this had earnings coming up today, and that's why the premium was so high with a 0 to 310 bid. And let's go to the next day. So if you ran it on Thursday, I'm sorry, if you ran it on Wednesday, still zero bid, it wouldn't have shown up. Still no option activity here. Oh, that's because I don't have the, oh, there it is, current, I'm sorry, folks. Yeah, there's the volume and open interest, 32 and 4. And let me go to yesterday for a 2-day trade. So the 470, 0 to 5. So it changed drastically again. The bid ask went from 0 to 5 after some trades were entered. The 28 open interest, we saw that it had a 4 open interest with the 20 or so contracts traded. So the open interest jumped up to 28. And then the 475 went up to 82. Okay, so that's what we were looking at there. Now the spread chain tool, okay, hold on 1 second here. Let me go through this. Yep, and so yeah, the spread chain there, that if I do the spread chain by itself, the midpoint spread chain, if I know a stock I'm interested in, I could type in CMG, and I'm sorry, I want to look at call credit and put debit parity. So we're going to use CMG. I want a spread width of 5, minimum net credit of 60, and yeah, at least one, but let's wipe everything else out. Don't care about that. And let's look for next week. Okay, take that out. All right, so yeah, using the midpoint, it's showing me a lot of the 2.5 spreads. Didn't give me the 5, which is interesting. Maybe they don't get a 60-cent net credit with the 5, which makes no sense. It should be there. Try that again. There we go. Okay. But yeah, see the 5-point spread, even at the midpoint, with a 5-point spread at the midpoint, you're not, at those high strikes, you're not getting anything viable there. Because remember what we saw earlier, if I had a bid of 0 to 310 on the 470 call on Wednesday or Tuesday, and at 475 I was 0 to 310 again, well, if it grabbed the same midpoint, it'd be no credit. It'd be 155 versus 155, so it would be a 0 credit here. So yeah, that's the spread chain there that you can use that. But I would start with the search itself, put in your basic criteria of what you'd want. And we saw that with the bear call. I started off very basic minimum net credit, 4 days out, 11% return, and maybe 1% out of the money with a 40 or 70% probability, something along those lines. And just use that as a starting point. You'll get some results, and then you can link to the spread chain to narrow that down even further. All right, well, that looks like all the questions that I had today. It is 5:35 Eastern Time. If anyone has a last-minute question, go ahead and send those in as well. And of course, remember, you can, I'm sorry about that, you can send us an email at any time as well if you have any further questions also, of course, if you have any last-minute questions there. Let's just do this. Here we go. Yeah, so if you think of anything later on, I just want to remind you, just send me a question anytime. You can send us an email to support@powerop.com. You can also call us during market hours, 302-992-7971. And of course, if you're not already there, I encourage you just to go to powerop.com, and you can put in your name and email address and take a 14-day free trial. So you have access to the site for 14 days with full use of the service. Okay? And at the same time, I apologize. At the same time, of course, we want to remind everyone that after your 14-day free trial, we do have different levels of service. The end-of-day service is $40 per month. The 20-minute delayed is $60 per month. And then, of course, the real-time service is $120 per month for every time you run the search. You get the numbers and calculations that very instant. Other than that, next week we'll have some webinars available for both RadioActive Trading and for PowerOptions. You'll see those posted on the PowerOptions and RadioActive Trading site. So just remember, you can register for that at any time, and we'll let you guys know when the archive of today's webinar is posted. At any time, of course, you can access the archive. Simply go to the free webinars tab underneath the Mine Home tab when you're logged in. But this is actually a public page that anyone can access at any time. I'll send that to all of you in the chat window. It's just powerop.com/webinars.asp. And of course, today's presentation would be posted in the requested topics section here as well. So here, even before that, Eli, there's the last presentation that we did that we archived from 8:15 was analyzing implied volatility. How can I analyze and search implied volatility and stock volatility? When should I look to roll my covered calls and more? But we'll post today's presentation here as well. But you'll also have access to the options strategies ones and the options concepts one. This is where I wanted to go. Earlier in this webinar, we talked about what was Gamma, what was Vega, how does that relate to it, what is implied volatility, the percent implied volatility range, and so forth. Did one webinar here called Implied Volatility, the Double-Edged Sword. Okay, and it's just a discussion here on, you can't trade without knowing implied volatility and only sell high IV. Well, that's a double-edged sword. And anyone who tells you, oh, you have to sell into high IV, yeah, but the option's high IV for a reason. It could go against you very quickly. It's probably got a high IV, like we saw with Sarepta, because some events coming up that could cause the stock to drop 60 to 80%. That's not something you want to be on the wrong side of with a cash-secured naked put, a covered call, or even a bull put credit spread, or a bull put credit spread, or a bull call debit spread. When you do bear call spread and you're right, that's great. And that's what we talk about implied volatility, and what the gurus talk about with can't trade about knowing implied volatility and only sell high IV. It's a double-edged sword. Also, there's a presentation here on Greeks and why you may not need them. Okay. We talked about looking at the gamma and the theta and the vega and the delta, of course. And we also talked about the IV, and we showed an example of it even today. Don't consider that one of the Greeks necessarily, but it's something that's along the lines there. And what do I mean by that is that we saw that married put that came up from Alibaba that was in the 86th percentile of its percent implied volatility range. Okay? And then we researched it further and saw that the motion, the actual true range, was so small that it didn't matter that it was at 86% because any volatility crush, if it reverted back to the norm, wouldn't hurt the position that badly at all. So what this webinar discusses, the Greeks and why you may not need them, is that look, if I do a covered call search or a cash secured naked put, and I find a stock that I like, that I am neutral to bullish on, I have the return that I want, I don't have any events coming up that might cause any sudden breakout in the stock or anything like that, if it matches my criteria and what I want to see specifically, but the delta is off from what my guru advised, or the implied volatility seems too low, Or the market, even worse, the IV over HV, the market points to it as being an undervalued option based on IV ratio and Black-Scholes ratio. Well, do I care what the rest of the market thinks? If I'm neutral to bullish on this stock, I have the return I want, the probability I want, and the credit that I want. Does it matter to me? If the stock stays up, that put's going to expire, I'm going to make my premium, which is what I want. I don't care if the rest of the market thinks it's undervalued. That's the position that matched my criteria. And that's what we discuss here a little bit more in the Greeks and why you may not need them for certain strategies. However, other strategies such as calendar spreads, iron butterflies, maybe even ratio call or ratio put spreads, double diagonals. Yeah, you definitely want to use the Greeks for those as well. I mean, you really want to use the Greeks for those. But things for maybe a standard covered call or just buying a call or buying a put, that comes into play a little bit more as well. But some of those strategies, the Greeks might not be as appropriate as you think. They might not be as much of a concern as you think when you enter a trade. But you can play around on the webinars page there and access those at any time. Take a look at them and see which ones appeal to what your needs are. And then, of course, as I mentioned, we'll let you know when today's webinar is published in the archives. Well, ladies and gentlemen, thank you for